We have some live trading analysis coming today. However, first, let's remind ourselves that it's Thanksgiving week, something institutional traders like myself would have been factoring into their trading. Is this something you factored into your trading during the week? I still find it incredible that even though traders in this day and age have access to not only transactional information such as order flow at their fingertips, but also solid macro fundamental analysis, they still somehow think that drawing an arbitrary supply or demand zone, then connecting up the dots is going to make them money. As you know, on this channel, we live in the real world. And so getting back to how serious investors trade, seasonally, we know Thanksgiving has a positive bias in the markets. We also know that the Fed has been making a lot of noises that perhaps they are looking to slow down the pace at which they increase interest rates. All very bullish factors. Now we're going to get into some amazing live trading analysis, but it's important we focus on this point a little more closely because that was a major factor in my long bias. The Fed has raised interest rates by 75 basis points 4 times in a row to 4%. The next meeting is in December, on December the 13th to be precise, and whilst the expectation previously was for another aggressive 75 basis point move at the next meeting, given the recent noises the Fed have been making that they are concerned about the lag effects of what they've already done to date, 375 basis points in 8 months, and also the fact that inflation is now starting to ease off somewhat. The latest core CPI reading of 0.2% month on month was the lowest reading in a year. So the market is starting to think that the Fed maybe won't be as aggressive as they have been, and maybe the peak in rates is in sight. This is all very bullish for the market. These are things I spoke about at length in my previous video titled "The Fed Crashed the Market," which you can check out later. The point is, hopefully you can see, all of these are factors when taken together have been very supportive for the market recently, and when we combine those factors with order flow, we really have an extremely powerful edge and are putting ourselves in line with what the very best institutional traders in the world are looking at. Completely the opposite of the random lines I see people drawing on social media. Anyway, talking of order flow, we're now going to get onto the charts. We have a bullish bias, and what order flow will allow us to do is to identify the fact that we have had short squeezes all week, something I was using to my advantage to get into long trades. All very exciting stuff. Let's go. Okay everyone, so we already know I have a short bias, as I've already explained at the start of this video. We can see the live market here, but one thing I want to do, let's actually do something very different today. I want to just break it down a little bit. I've had a lot of people ask me about the footprint and some of the other order flow tools that it's possible to use. So let's actually break this down just a little bit step by step. Let's remember, we've got a long bias, right? We want to buy the market. I've already explained the reasons at the start of this video that go into that decision. There will be other things like market profile, which I've talked about in many other videos, but ultimately we want to buy the market. It's gone up, so we're looking for the market to pull back a little bit, but we need to find out the right time to buy. And I talked about these short squeezes, right? And what I want you to do is I want you to keep an eye here, and then the same equivalent move, we see it start to pull back, is happening here. I want to actually cast your mind towards thinking about the difference between what you're seeing here and what you're seeing here. Basically a complete lack of information here. Whereas here we can actually start to identify where the short squeeze may take place. Very briefly, a short squeeze is obviously where shorts get squeezed. Now, the effect is going to be stronger, would you agree, if there's a greater number of shorts, right? Makes sense. The more shorts there are, the more they're going to scream and exit their position when the market starts to go against them. So we want to see, would you agree? You agreed that we want to see as many shorts as possible enter the market against us, so that when it starts to go in our favor, what do you do when you get short? You start getting nervous and you buy the market to close your position out. Okay, so obviously we want to see the most amount of shorts possible. So how do I identify that? And that's what I want to just quickly show you here. So footprint is just one way. There's many ways I do it. Footprint is one possible way. So quite visually, appealing and nice and easy, especially if you're starting out in this business, for you to learn about order flow. It's literally sellers here and buyers, right? Think about it. When you're on your retail trading platform, same thing. You have a bid and you have an offer, right? And if you want to sell the market, you hit the bid, and if you want to buy the market, you lift the offer, all right? Same thing. So it's hitting the bid on this side, so sellers, and then this side is offers, buyers, right? So what we're seeing here, what the footprint does, is one minus the other is recorded there, all right? So can you see, for example, the difference between 26 contracts sold and 8 is 18 negative, because we had more sellers than buyers, so negative. And one of the things that I'm going to start talking about a lot more, but haven't so much, is if you walk into any institutional firm, okay, you will see loads of traders using the footprint, because obviously they do want to get more information than just what is on a plain candlestick. That's obvious. What I've actually done is I've gone one step further, based on my experience working for many years in lots of institutions, as a lot of you will know, is all I've really done is I've taken this information and I've put it in a nice format that's easy for me to understand as the market is moving quickly. All right, so it's not, do you see, I'm not using any lagging indicators, averages, or anything that distorts the data. I'm taking the raw order flow data and I'm just putting it in a nice, easy to understand format. So the delta here that you see, 161, let's actually calculate it together. All right, so these are all the sellers, these are all the buyers. I've actually done it here on an Excel spreadsheet just to show how easy this is for anyone to do. Okay, the sellers here, the buyers, I've taken the exact same numbers that you see here, 0, 26, 30, 15. You see, I've put the same numbers, I've summed them up. Okay, so that's just the sum. 278 contracts sold, 117 bought. What's the difference? 161 negative, because we've got 161 more sellers than buyers. So can you see that? 161. I'll talk about the delta change and all these other numbers in another video, but ultimately, to be fair, it's just the difference. So before we had 217 sellers on the previous candle down, net negative, so slightly less net negative, so the difference is 56. But the one I want to really focus on is this delta percentage, okay? So you see minus 40.76%. Really, very simple. All we're doing is we're taking the total number of buyers and sellers in one candle. So the sum of all these buyers and sellers. So 395 contracts were bought and sold, okay, in that one candle, which you see here, this candle here. Okay, so you can do it yourself. Add it up, pause the video, add it up, all of these, and you get to 395. We know that the negative difference was 161. It's literally just one over the other. Equals 161 divided by total number of contracts minus 40.76. And what do you have here? Minus 40.76. Really simple. Obviously, the more negative that percentage is, the more negative the difference was between buyers and sellers as a proportion of total volume. All right. So obviously, the more negative this number is, the more shorts there are that we can look for the squeeze to take place on, all right? So do you see, what I've done is I've taken what most institutions are using, that I've always been taught to use as I was working my way through various firms, and I've taken it another step forward where I'm just allowing myself to see kind of a little bit more in terms of some metrics of how short are these sellers actually getting. So you can see we're miles apart from what you actually see on your normal chart. So what we're now ready to do, and just remember one final point. So we can see in particular, minus 40, minus 30, we're starting to get very short in these areas. If the market starts to go above there, that's the squeeze, okay? That is actually the squeeze taking place. Okay, that is a short squeeze. So I've identified shorts to be squeezed, okay? Short squeeze, that is exactly what it is. So as we start to go above here, that's a very good opportunity. You know, if we can pull back and start to move, that will help me time this. Because otherwise, how do I know? How do I know how far back to go and so on and so forth, right? Combined with the other factors that I spoke about at the time. at the start of the video. So let's now press play. Okay, and just let it play out. So again, just to remind you, obviously this is the Thanksgiving week. It's my live account. So just let the market play here just for literally 1 minute. All right, so I'm going to show you that the market is pulling back. I'm obviously looking for some sort of continuation. All right, obviously I don't know exactly where I should time my entry. You can see the market is now starting to really pull back. So do you see initially, the point is when the market was initially pulling back here, it's impossible for me to tell just on the normal chart where is the exact moment where, or area on the chart in terms of price, where shorts are really starting to get concentrated. Now, if I look here, do you see the 40.76, all right, and the 30? I can see that this area potentially, in particular this area up here, because that is where I've got what? My 40.76, my heavy squeeze. Do you see the candle before? Even though we had shorts, only 2.19% as a percentage where we had a short delta of the total volume. So even though that candle there, do you see it looks bearish? This area here of this candle looks bearish, but actually it's this area where I really want to start thinking about getting longs on. So that's an area I've already identified, this area here, okay? And the market is moving a lot, so apologies, but just give me 1 second. We can see as the market starts to move above here, this is where I really start to get interested. Surprised I haven't taken the long already, but obviously just being ultra cautious because we are already quite high up. And there you go, first contract entered in that region there. Do you see just above 40.76 where we had a heavy short squeeze, okay? That's not going to be the only factor. There would have been some other factors. I do like to use obviously a variety of volume tools, but just want to show you exactly how you can utilize volume and also highlight how on this, you remember I said to you at the start, I need to keep an eye here. Whilst all this was going on, you're not going to see any of this information here. So really, you're limiting yourself in your trading by just kind of looking at nothing more than just price, right? You're just missing out on a whole bunch of information. You can see I've entered another contract there in the hope that obviously the market moves up for the reasons I mentioned at the start, positive week, Fed, Thanksgiving, so on and so forth. And you can see here, in fact, this is where you can really see the effects of the short squeeze. Do you see this? 811 net positive delta. That's a lot of those guys here on the minus 40.76 exiting their positions. All right. So yes, it's a lot of longs, but it's also exit. So that actually confirms we have a short squeeze in play. All right. So obviously reason to hold my trade for a little bit. And I'm just going to fast forward it and show you the outcome. Save you having to sit around, and you can see it really started to pop. Okay. And then 2/3 taken off of the position. And because of how much the market had moved, obviously the pullback wasn't deep, right? It was quite a shallow pullback and we're already quite high. I've then started to just move my stop and keep it quite tight. Okay, so you'll see that even though the market does move quite a lot, the last position gets taken out here quite quickly, I believe. There you go. Okay, so that's plus $950 on the day. Fairly quick trade in and out, as you can see, utilizing volume information. Made a lot of sense. No random arbitrary areas, lines, dots, none of that. Using the raw data, which is what institutions are doing. $950 on this day. The market did continue to go up and we did continue to have the short squeeze, but obviously risk management kind of took over there. I'm very happy with the outcome, especially given the shortened week, low volume, and pretty much called it a week after that trade. So when taken all together, this analysis was completely different to what you might have been used to seeing, right? Now you can see why there's such a gulf between retail and institutional traders, but there doesn't have to be. To find out more, watch this video here, which will put you on the right path to moving forward with your trading career.